Ladies and gentlemen, good day and welcome to the UFO Moviez India Ltd Q1 FY25 earnings conference call hosted by Vinstra Securities Limited. As a reminder, all participant lines will be in the listen-only mode and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star and then 0 on your touch-tone phone. Please note that this conference is being recorded. I would now like to hand over the call to Tushar from Vinstra Securities Limited. Thank you and over to you, Tushar.
Thank you. Good day, ladies and gentlemen. On behalf of Vinstra Securities Limited, I welcome you all to UFO Moviez India Limited Q1 FY25 earnings conference call. The company is represented by Mr. Rajesh Mishra, Executive Director and Group CEO, along with Mr. Ashish Malushte, Chief Financial Officer of the company. I would now like to hand over the call to Mr. Mishra for opening remarks, post which we can start the question and answer session. Thank you and over to you, sir.
Thank you, Tushar. Greetings everyone and thank you all for joining our Q1 FY25 earnings call. Q1 FY25 had a slow start due to the general elections campaign in April and May and a lower number of movie releases. During the quarter, 476 movies were released, including different versions and languages, compared to 581 in Q1 FY24 and 550 in Q4 FY24, reflecting an 18% decline year over year and a 13% decline quarter over quarter. The quarter started with the underperformance of movies such as Bade Miyan Chote Miyan featuring Akshay Kumar and Tiger Shroff, Maidan featuring Ajay Devgan and The Family Star featuring Vijay Devarkonda in April. This was but followed by modest reception of films such as Srikanth and Mr. and Mrs. Mahi, both starring Rajkumar Rao. However, June turned out to be a better month with a sleeper hit like Munjia and other performing well without. This film performed well without any A-list star cast. Alongside, there were successes such as Maharaja featuring Vijay Sethupathi and Anurag Kashyap and Chandu Champion featuring Kartik Aaryan. This was followed by release Kalki 2898 AD featuring Prabhas and Amitabh Bachchan on 27 June 2024, right at the end of the quarter. Overall, the underperformance of tentpole films and lack of successful content during the first 2 months negatively impacted the quarter's results, affecting advertisement and theatrical revenue. Advertisement revenue for the quarter stood at 219 million compared to rupees 235 million in Q1 FY24. Corporate advertisement revenue contributed 160 million compared to 182 million in Q1 FY24. While revenue from government grew by 55% from 38 million in Q1 FY24 to rupees 59 million in Q1 FY25. The theatrical revenues for the quarter was 240 million in Q1 FY25 compared to 248 million in Q1 FY24. While both theatrical and advertisement revenue experienced a modest decline in revenues from exhibitors grew by 39% from rupees 318 million in Q1 FY24 to 443 million in Q1 FY25. On the screen network, our advertisement screen network grew to 3769 as of June 30, 2024, compared to 3234 as of June 2023, marking a 17% year-over-year increase with the addition of 535 advertisement screens. However, overall there was a slight 2% decline quarter over quarter. Now moving to the headline numbers for the quarter ended June 30, 2024. Consolidated revenue of Q1 FY25 was rupees 945 million, up from 853 million in Q1 FY24. EBITDA for the quarter stood at 66 million compared to 163 million in Q1 FY24. Net loss of 42 million in Q1 FY25 compared to a net profit of 25 million in Q1 FY24. Regarding the consolidated funds position, the balance at the end of the quarter stood at 1,066 million as of June 2024. The company continues to be net cash positive even after considering outstanding debt. Looking ahead, with the continued success of Kalki 2898 AD in July and an exciting lineup of upcoming releases across languages, including Auron Mein Kahan Dum Tha, Stree 2, Veda, Khel Khel Mein, The Goat, Devara, Veti and Deva, Bhul Bhulaiya, Singham Again, and Pushpa 2, we are hopeful for a positive turnaround in the coming quarters. I would like to take this opportunity to thank all our stakeholders for their continued interest in the company. With that, I open the floor to take your questions. My colleague, Mr. Ashish Maluste, CFO, and I will be happy to take your questions. Thank you.
Thank you, sir. Ladies and gentlemen, we will now begin the question and answer session. If you have a question, please press star and 1 on your telephone keypad and wait for your turn to ask the question. If you would like to withdraw your request, you may do so by pressing star and 1 again. Ladies and gentlemen, if you have any question, please press star and 1 on your telephone keypad. First question comes from Ankit Kanodia from Smart Sync Services. Please go ahead.
Yeah, thank you for taking my question. And before asking my question, I would like to thank you for including making it a point to share the split between multiplex and single screen, which we discussed in the last call. So really appreciate that, sir.
In fact, we should thank you for bringing such important point to our notice, and I'm glad that you brought it to our notice and we included it. Thanks a lot.
Yeah, thank you. So for my first question is related to that only. So roughly around 2100 screens are multiplex and about 1600 or 1700 would be about single screen. Is it possible for you to give some breakup as to how is the revenue split between these two?
You mean in terms of advertisement revenue?
No, I'm talking about total revenue. I think bulk of it would be, I think even advertisement revenue will work because in case of
Let me quickly touch base on the two key revenue streams. One is the revenue that we generate by providing services to distributors called content delivery charges.
Yes.
So here are fees based on the actual play out of shows that happen in the screens, and it is also dependent upon the age of the film, which means we charge only in case of Hindi, we only charge for first 2 weeks, and thereafter we don't charge anything. Similar, there is some arrangement for regional where we charge initial weeks higher amount. So in case of multiplex versus single screens, the trend is such that the number of movies that get played out in multiplexes per screen are higher than single screens. The number of movies that are getting released every week. So in that sense, mathematically, simply put, the multiplex is a better unit for us for CDC, because if a single screen is running, say, 40 movies or 35 movies a year, a multiplex per screen may run 45 movies or maybe sometimes 50 movies a year. So this is how, then you multiply the rate, because rate is same, my service fee. So this is where there is a differentiation in the revenue that we generate from distributor service fee. Now when it comes to advertisement, you have asked a very pertinent question. Now here the situation is we don't really, it's a network sale most of the time that we do. Which means if an advertiser is coming for, say, Mumbai region, or if an advertiser is coming for, say, Karnataka region, or if advertiser wants to do in, say, Hindi-speaking market, then we offer the entire network to him as a whole. and that's how the rates are determined. Okay? So the rates in a way are flat for any screen. But we know that these multiplex are the critical screens which is driving the advertisers to this network. But when we are billing him, we would bill him at a network rate, which means every screen in the network gets billed at the same rate. And therefore, even if you the billing generated in multiplexes versus single screen, therefore is at the similar level. Again, here the difference is, since multiplexes will run more shows, they would run more advertisements, and to that extent the billing will be higher. But having said that, this is not the real representation of the potential of this multiplex. As we know that, as you must have understood by now, the multiplex being the key driver, those screens get us the business. So tomorrow if you have to sell only multiplexes, we'll be able to sell a much higher level. But since we are doing a network sell, it appears that the rate is common across multiplex and single screens. So that's how the business is at our end. If you want any further information, then I can provide it to you. But this is how we actually do the sales of advertisement.
No, that was very helpful, sir. And if I got it correctly, basically this trend which we are seeing since mostly after COVID is that we are getting more and more multiplex screens compared to single screen in our total bouquet. It is going to help us in terms of, more importantly, in terms of ad revenues, right?
Absolutely. In fact, nowadays, single screens don't really come up. I mean, every new screen is mostly a multiplex, and every new screen needs a service provider. So when we compete and get that particular property, a new property, that new property generally always is a multiplex. So you're right, as we proceed from here in future, my mix of multiplexes will keep getting better and better over single screen.
So while what Ashish mentioned is absolutely bang on, the one point that we just need to keep in mind is the single screens provide a larger reach for the advertisers in the region, and single screens also have a larger higher seating capacity. That's why also advertisers prefer them compared to a multiplex which would have say 150, 200, a single screen would have 700, 800 seater capacities. So that's why they are an important part of the mix, but the driver screens will obviously become the multiplex.
Got it, sir. That was very helpful. Sir, moving on to the next question. In the last call also we mentioned that even when we don't have too many blockbuster movies, what really drives our business is that how many movies gets released. And we had, I think, close to 500 movies released last quarter. And this time number has been much lower than that, as you mentioned in the opening remark. Now, this is something where we have no control, as per my understanding. This is where the industry, whatever the number of releases will happen. So, and this then this remains a long-term threat to our business model perennially. So, do we think as a management, do we think hard about it? Okay, how can we do something about it? As to even if in quarters where there are less releases, is there any scope of bumping up the revenue from a longer term perspective? You can't do things on a quarterly basis. It is not going to be sustainable in the long run. But from a longer term perspective, do we think on some lines here?
No, true. You are absolutely right. But the thing that we have to see here is that even when we plan our things, film is pretty much a seasonal business. So what will be true for quarter one would not be true for quarter two or three in the festive season, or in the quarter three like around Christmas time. So typically the quarter two and quarter three are always the better quarters for us on certain areas of film release and all those things. And Q4 also works on certain fronts from the, let's say, advertising front or the government front. It was working very well earlier. Now, this is something which is a peculiar situation that we had the election results over here. We had the IPL also happening over a period of time in these things. So, multiple factors take place. Like, this will not be true in the Q1 of next year, for sure, because there is not going to be any elections. There is much better maybe a lineup of release. So bottom line is, yes, the business is directly linked to the number of releases, and fate of the films is also very important for our business.
Right.
But as I said, it's a seasonal business. It's never in a linear, straight divided up business from Q1 to Q4.
So Ankit, if you actually see what has really affected the performance of exhibition business in this quarter, including us as a service provider, is not really, I mean, partly yes, reduction in number of films, but my business, if you see, what we are basically in a network business, we monetize our network. So as long as the movies are running in the theater, we have opportunity to monetize. So it would not really happen that because there are less movies, the shows have completely been stopped in a particular theater. There is a reduction, but not a direct proportionate reduction, which means if there are 20% less movies released in this quarter, which is a fact over last quarter, that doesn't mean that 20% of the theaters were closed, okay, or 20% of shows didn't run. But what happens is, because of the lesser number of movies, since we don't get newer movies in more proportion, higher proportion, my revenue from CDC goes down. But more than this, the bigger impact is when what happened in this, say, quarter, the first 2 months, the movies didn't really perform well, which were expected. Now, when that happens, although there are shows running of maybe old films or the same film in the remaining period of the quarter, the advertisers would not come back with the same kind of intensity. And therefore, more than the number of movies, what really damages a particular quarter or period is when you have a longish stint of movies not doing well. In this quarter, there were first 2 months, if you see, many expectations, good number of, in April, 3 good movies were expected to do, I mean, 3 good movies were there, but they didn't do well. So this damages the advertisement potential and the actual revenue.
Right. Now, this is a very important point you have raised. So that, with that, I have a follow-up point which we were discussing as a team also. What I have observed, or what we have observed in our team, is that there are a multiple number of movies, and it is becoming a trend now, multiple number of good quality movies which are not doing good at box office, because you think that probably 1 month later I can watch it on OTT. So examples like Lapata Ladies, and recently Srikanth you have mentioned. So there are many people who have watched these movies on OTT, but they would probably, but when it comes to a movie like, say, Kalki, where you need to go to the cinema hall to actually enjoy the crux of what is there or what are the special effects. So maybe, do you see that as a risk, as in more people going to cinema to watch only those movies where there is some cinematic flavor which you cannot have at your home or in OTT? And for all the rest good quality movies, because you have an option of OTT 1 month, you can wait for 1 month. So probably you are not, even though you know that the movie is very good, very well made, but probably more people are not going to the cinema. It would be great to have your view on that.
Yeah, so the way to see this would be that it's, if you see just the last quarter itself, when you have a film like Munjia, which has virtually a very new star cast, and it is a horror film, it do business of 100 crore plus. You had smaller films like Lapata Ladies and Crew and Article 370, which had no big star cast and no big, production setup. They drew the audiences. So this is pretty much film-related business that works out. Only thing is, when these are smaller films with no great buzz around them, from the point of view of star cast or production values, they don't have that wider release. But what we are seeing here is, it's a very healthy trend the way I see it. When you have 2 Rajkumar Rao films doing well in a period, and non-star cast films that I mentioned like with Munjia and all, when they start performing in cinemas, I'm talking, I mean, everyone had the option that this film will come on the platform of OTTs. Right. But Hindi OTT platform is a delay release of 8 weeks. That is one. Secondly, it's very heartening to see such type of films performing well, because that increases your total pie of good films that are coming in the market. So there is footfalls happening on these films. Even like, for example, you had Shrikant. You take many films like this we have seen in the past. And another very healthy trend that we are also seeing is the South films, which are now migrating into the North market in dubbed versions and all, and they are finding much greater acceptance by the audiences.
Right.
Again, these films are getting viewership in the market. The bigger films like Kalki and all, of course, have a different level of pull from the fact that they would want to see it only in a cinema, for sure. But it's not like an either-or situation. A good film is finding audiences, that is for sure.
Right. So one last question, if I may.
I'm sorry to interrupt, sir. Can you join back the queue?
Sure, no problem.
Thank you, sir. I request the participants to restrict with 2 questions in the initial round and join back the queue for more questions. Next question comes from Nitin S. Dharmawat from Ahuram Capital. Please go ahead.
Yeah, thank you for the opportunity. Am I audible?
Yes, sir.
Yeah, just speak a little louder, please.
Yeah, sure. Wait a minute. Oh, I hope I'm audible now.
Yeah.
Hello. So I wanted to understand why our expenses have gone up so much, and are these going to be recurring, or we'll have a better control on the expenses, especially purchase of digital equipment that I can see in the results. So can you please elaborate on that, and how the EBITDA is going to be in the subsequent quarter, as we are anticipating better business in this quarter and the subsequent quarters?
Yeah. So when you look at so Nitin, thanks a lot for this question, and let me try and explain the point. So your observation is right that the overall expenses appear to have gone up in this quarter, but the single largest reason for this increase in expenses is the cost associated with the sale of products. So sale of product revenue, which has gone up by 84% from 14 crores last year to 26.5 crores this quarter, which in both these quarters have an approximately 20-22% operating margin for us. The corresponding cost of the purchased goods has also gone up. So it has gone up by about 8.6 crores. So if you see my total expenses, which have gone up by 18.5 crores, of this almost 9 crores, more than half, is only on account of this purchase of equipment. But when I say that, actually net of expenses, the net revenue that I have made in this quarter from sale of product revenue line is higher than Q1. So my suggestion would be to actually look at this sale of product revenue at a net level, and in a way just take off the entire cost, because that will give a clearer picture, because it's a trading business, so you buy and you sell, and this is the only trading business line that we have. So in that sense, this increase in expense can never be a concern. In fact, it's a good thing, because the higher the expense, higher is your margin, margin in the sense the realization, which actually happened in this quarter also. The other second line of expense that has gone up is advertisement share, and that has gone up because I am not sure, Nitin, if you were there in some of our earlier calls, but we have made a very significant strategic advertisement network rights acquisition down south of a network, very strong network called TSR, and over there it happened in Jan, and during that time we had said that we'll take 2 to 3 quarters for the entire integration to happen, post which we can start effectively monetizing that network along with our network. Cost to them is close to 3.5 crores, 3.3 crores per quarter. So that cost is going away every quarter. I mean, at least for these 2 or 2.5 quarters, I'll have to keep paying, but corresponding revenue may be far too lower. But if you're absolutely looking at the cost line item, which was your concern in the question. Out of this 18 crores, more than half is cost of goods sold, which is 9 crores. Of the balance, 6 crores is an increase in advertisement share. Of this increase in advertisement share of 5.9 crores, 3.3 crores is the share that we have paid to TSR. Why I'm explaining this is, both these increase in ad revenue share and increase in cost of goods sold is a healthier thing for the business, because both are going to straight away add to your revenue potential in a very significant way. While we are on this point, I would draw attention on the SG&A and employee cost. So that is where we have been very, very cautious from the middle of the pandemic. And if you see SG&A, we have had a marginal increase of 2% YOY this year. And in case of employee benefit also, there's only 14% increase. And this 14% increase may appear higher, but I would like to quickly bring to your notice that there was a massive change that we did in our payout structure to the employees last year, and we had converted 20% of fixed salary into variable. So this year there was some amount of normalization and rationalization that was done, which has led to an increase of about 14-15% in employee cost. So employee cost and SG&A are the two items which in business like ours we should keep a track on, and those are under check. Direct operating expenses going up, sir, in my view, is in a way a healthy option, and both cost of goods sold and advertisement share directly will contribute to us. Cost of goods sold has actually contributed 3.5 crores in this quarter. So that is the little longish explanation to the question that you had about why the expenses have gone up and is it area of concern.
I understand. And we have announced some partnership again in the last quarter. So will there be any impact on the subsequent quarter for the expenses part for this as well?
You mean in terms of costs? No. That's a revenue sharing arrangement. So the costs, we have not entered into that agreement. So are you talking about the latest announcement that we did?
Yes.
Sorry, I can't hear you. Hello.
Yes.
Okay. So that is not going to add to cost because that's a revenue sharing arrangement, and there's no fixed commitment as such that the company has in that business arrangement.
Got it. My next question is about the advertisement revenue. In the previous quarters, we were having slight struggle, rather I would say big struggle in getting revenue from the government sector and PSUs. So are we getting the government revenue back because the numbers have improved in this quarter? So are we getting more revenue, or is it coming mostly from the PSU still and not exactly from the central government? So can you elaborate on that, and how sticky this revenue is going to be going forward?
So yes, the challenges on the allocation by central government ministries towards cinema network continues. Even in this quarter, we have not got any meaningful revenue. But in this quarter, since elections were there, even if they were doing a regular spend, this quarter would have been a dry quarter for us on the central government front. So that's a fact of this quarter. But more importantly, as of now, we don't see a major change in the allocations. Those are done by the ministries. Probably we need to wait and see when the new setup is completely in saddle with the new government. But we have, for last 7 quarters, we are going ahead assuming that central government may not have a positive views towards doing more allocation towards in cinema network, and we have focused our strategies on the other avenues, more importantly corporate, retail and state government. In this quarter, state governments continued to spend, but again because of the election period, that spend was less. But as it has always happened in the past, the political parties, when they want to do their campaigns, they find cinema as one of the most attractive medium. And this quarter we have generated about 4 crores of revenue by advertising, by giving our inventory for advertisements for the political parties for their election